Let me ask you something. If I told you that most people saving for retirement right now are already behind and they have absolutely no idea, would you want to know if you are one of them? Or better yet, would you want to know if you are one of the rare few who are actually way ahead? Because here's the truth. Most people will spend 30 or 40 years working, saving, and doing what they think is the right thing, only to reach retirement and realize they fell short. But a small group of people, and I mean a very small group, are quietly building retirement portfolios that are running laps around everyone else. And they are doing it without stress, without gambling their savings on risky bets, and without burning out chasing the next hot stock tip. Today, I am going to show you the 3 clear signs that your retirement portfolio is way ahead of the game. And if you do not have these signs yet, do not worry. Because by the end of this video, you will know exactly what moves to make. I am Knox, and if this is your first time here, welcome. On this channel, we break down smart finance strategies, automation tools, and the systems that help everyday people build real wealth on autopilot. If that sounds like something you want more of, hit that like button right now and make sure you subscribe so you never miss what we put out. Let us get into it. All right, before we jump into the 3 signs, I want to paint a picture for you. Imagine 2 people. Both are 45 years old. Both have been working since their mid-20s. Both earn roughly the same income. From the outside, their lives look almost identical. But when you look at their retirement portfolios, the gap is massive. One of them is going to retire comfortably, with income flowing in month after month without ever touching the principal. The other one is going to have to make some very uncomfortable decisions in their 60s. What separates them? It is not luck. It is not some secret investing hack. It comes down to 3 very specific things, and those are exactly what we are covering today. Sign number 1, your portfolio is growing faster than inflation and faster than your contributions. Here is the thing that most financial influencers will not tell you. Contributing money to your retirement account is table stakes. That is the bare minimum. The real question is your portfolio growing faster than the money you are putting in? Let me break that down. In 2024 and into 2025, inflation has been a major topic for everyone. Even when inflation cools down to around 3%, that still means the purchasing power of your money is being eroded every single year. So if your portfolio is only growing at 3%, you are essentially running in place. You are not falling behind in raw dollar terms, but in real terms, in terms of what your money can actually buy you in retirement, you are standing completely still. Now, people who are way ahead understand this deeply. They are not just asking, did my balance go up this year? They are asking, did my portfolio grow faster than inflation and faster than what I put in? That is the real benchmark. So what does this look like in numbers? Let us say you are contributing $1,000 per month to your retirement accounts. That is $12,000 per year. If your portfolio earned $15,000 last year from investment gains alone, meaning your investments made more money than your actual contributions, that is a powerful sign you are ahead. Your money is working harder than you are. Your portfolio has reached what many financial experts call a compounding inflection point. And once you hit that point, things start to accelerate in a very big way. Now, how do you actually get there? First, you need to understand your real rate of return, not the number your brokerage shows on the front page, your real rate of return, which is your nominal return minus inflation. If your brokerage is showing you 9% growth, but inflation is running at 3.5%, your real return is closer to 5.5%. That is still solid, but you need to know that number, not the headline number. Second, you need a diversified portfolio that is positioned for growth during your accumulation years. This means not being overly conservative too early. I talk to people in their 40s who have 60 or 70% of their retirement accounts sitting in bonds or cash equivalent funds, and they do it because they are scared of volatility. But here is the danger. Being too conservative too early is actually one of the biggest risks to retirement security. You have time on your side. Use it. Third, you need to automate your contributions and your investment allocation. Automation removes emotion from the equation. When the market dips, automated systems keep buying, which means you are purchasing more shares at lower prices. And when the market climbs, your existing positions are growing. This is the engine behind people who are way ahead. They set up systems that work while they sleep. If you open your account statement right now and your portfolio gains are outpacing your personal contributions, congratulations. That is sign number 1 that you are way ahead of the crowd. Sign number 2, You have multiple income streams working inside your portfolio. Here's where things get really interesting. Most people think about retirement income in one of two ways. Either they plan to draw down a lump sum savings account and hope it lasts long enough, or they are counting on Social Security to cover the gap. And I will be honest with you, both of those strategies on their own are incredibly fragile. People who are way ahead of everyone else have built multiple income streams inside their portfolio. And this is not about being rich. This is about being smart. Let me walk you through what this actually looks like. The first income stream is your core retirement account growth, your 401k, your IRA, your Roth accounts. This is the foundation. But people who are ahead do not stop there. The second income stream is dividend income. Dividend-paying stocks and ETFs generate regular cash payments, sometimes monthly, sometimes quarterly, simply for holding them. And the beauty of dividend investing is that you can reinvest those dividends during your accumulation years, which creates a compounding snowball effect. Then when you reach retirement, you can switch from reinvesting to receiving, and suddenly you have a stream of income that shows up like clockwork without selling a single share. Here is a number to put that in perspective. The S&P 500 has historically delivered an average dividend yield of around 1.5 to 2% per year. On a $1 million portfolio, that is $15,000 to $20,000 in annual dividend income alone. And if you have built a more dividend-focused allocation, that number can be significantly higher. The third income stream is real estate exposure. Now, I know what you are thinking. I do not want to be a landlord, and I completely understand that. But here is the thing. You do not have to be a landlord to have real estate working for you in your retirement portfolio. Real estate investment trusts, or REITs, allow you to own a fractional piece of income-producing real estate without ever dealing with tenants, maintenance calls, or property taxes directly. REITs are required by law to distribute at least 90% of their taxable income to shareholders. That means consistent payouts and consistent cash flow inside your portfolio. The fourth income stream that people ahead of the curve are building is what I call automation income. This is where tools, systems, and intelligent financial technology work on your behalf. Whether it is automated rebalancing that keeps your risk profile optimized, tax loss harvesting tools that reduce what you owe the IRS, or smart allocation platforms that shift your exposure based on market conditions, automation multiplies your results without multiplying your workload. And on this channel, we dive deep into exactly these kinds of tools. So if you have not subscribed yet, make sure you do that right now, because this is exactly the kind of content we cover every week. Now, the fifth income stream, and one that is often overlooked, is the power of a health savings account, or HSA. If you have access to a high-deductible health plan, an HSA is one of the most powerful triple tax advantage tools in existence. Contributions go in pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. After age 65, you can also withdraw for any purpose and simply pay ordinary income tax, just like a traditional IRA. Healthcare is one of the largest expenses in retirement. Having a dedicated, growing fund to cover it is a massive advantage. So here is the question. When you look at your retirement strategy right now, how many income streams do you have set up and growing? If the answer is 2 or more, you are building the kind of multi-layered foundation that separates people who are way ahead from people who are hoping their savings just last. Sign number 3, you have a tax strategy, not just a savings strategy. This is the sign that most people completely ignore, and it might be the most powerful of all 3. Here is a sobering reality. Every dollar sitting in a traditional 401k or traditional IRA has never been taxed. That means when you pull it out in retirement, which you will be required to do thanks to required minimum distributions starting at age 73, the government is going to take their cut. And depending on how much you have saved, that cut could be enormous. People who are way ahead understand that retirement planning is not just about how much you save. It is about how much you keep, and that requires a tax strategy. Let me give you a few examples of what this looks like in practice. First, Roth conversion laddering. This is a strategy where you systematically convert money from a traditional account to a Roth account during lower income years, often in the gap between early retirement and when Social Security begins. You pay the taxes now at a potentially lower rate, so that all future growth and all future withdrawals are completely tax-free. People who execute this strategy well can save hundreds of thousands of dollars in lifetime taxes. Second, tax bracket management. People who are ahead do not just contribute money blindly, they think about which account gets each dollar. If you are in a high tax bracket right now, pre-tax contributions to a traditional 401k reduce your taxable income today. If you expect to be in a higher bracket in retirement, or if you want tax-free flexibility, Roth contributions make more sense. The goal is to manage your tax brackets across your entire financial lifetime, not just this year. Third, asset location, not just asset allocation. This is a subtle but powerful concept. It means placing the right types of investments in the right types of accounts based on their tax treatment. For example, bonds and REITs generate regular taxable income, so they are best held in tax-advantaged accounts like IRAs or 401ks. Meanwhile, growth-oriented stocks that you plan to hold long-term benefit from the lower long-term capital gains tax rates that apply in taxable brokerage accounts. When you match asset type to account type, you can meaningfully increase your after-tax returns without changing a single investment. Fourth, Social Security timing strategy. This one surprises people. When you claim Social Security, dramatically affects how much you receive over your lifetime and how it interacts with your other income and taxes in retirement. Claiming early at 62 locks in a permanently reduced benefit. Waiting until 70 can increase your monthly benefit by up to 32% compared to claiming at full retirement age. And here's the part people miss. If you have other income streams covering your expenses in your early retirement years, delaying Social Security can be one of the highest return, zero-risk financial moves available to anyone. Fifth, charitable giving strategies. Now, I know this sounds like something only for the ultra-wealthy, but qualified charitable distributions, or QCDs, allow people over age 70 and a half to donate directly from an IRA to a charity, and that distribution counts toward their required minimum distribution without being counted as taxable income. For people who are charitably inclined anyway, this can reduce their tax bill significantly. People who have a tax strategy built into their retirement plan are not just saving smarter. They are playing an entirely different game. They understand that the government is a silent partner in every traditional retirement account, and they are making moves to minimize that partnership as much as legally possible. Now let us tie all three of these signs together, because they do not work in isolation. They build on each other. When your portfolio grows faster than your contributions and faster than inflation, you have compounding working in your favor. When you have multiple income streams inside your portfolio, you have resilience, because no single market move, no single bad year can destroy your plan. And when you have a tax strategy embedded into everything you do, you are maximizing what you actually get to keep from all that hard work. Here is the uncomfortable question I want to leave you with before we get to the conclusion. Most people spend more time planning a 2-week vacation than they spend planning their 30-year retirement. And there's nothing wrong with taking a great vacation. But the people who are way ahead, the people we have been talking about throughout this entire video, they treat their retirement like a system, a machine, something that runs, grows, and optimizes whether they are paying attention to it that day or not. And that is the core philosophy of this entire channel. We are not here to give you hype. We are not here to tell you to throw your savings into whatever is trending on social media this week. We are here to help you build systems, financial systems, automation systems, tax efficiency systems that stack the odds in your favor decade after decade. If you are doing all three of the things we talked about today, even imperfectly, even partially, you are already in a better position than the vast majority of people heading toward retirement. And if you are not doing all three yet, now you know exactly what to work on next. All right, let us bring it home. We covered 3 signs that your retirement portfolio is way ahead of everyone else. Sign number 1, your portfolio is growing faster than inflation and faster than your own contributions. Your money is working harder than you are. That is the compounding inflection point that changes everything. Sign number 2, you have multiple income streams built into your portfolio. Dividends, real estate exposure, tax-advantaged health savings, and smart automation tools are all working together to create layered, resilient retirement income. Sign number 3, you have a tax strategy, not just a savings strategy. You understand Roth conversions, bracket management, asset location, Social Security timing, and every legal tool available to maximize what you keep. Here's your action step before you close this video. Open your retirement account right now, even if just on your phone. Look at 3 things. 1, is your portfolio gain this year bigger than your contributions? 2, how many income streams do you have working inside your portfolio? 3, when was the last time you thought seriously about your tax strategy in retirement? Those 3 questions will tell you a lot about where you stand. And if you want to go deeper on any of these topics, the automation tools, the Roth conversion math, the asset location strategies, we cover all of that right here on this channel. Make sure you are subscribed, hit the like button if this video gave you value today, and check out the next video on screen right now for even more on building a retirement that runs on autopilot. This is Knox, and I will see you in the next one.